All right, section 70108, extension and modification of limitation on deduction for qualified residents' interest. So this is one of those things. This is where mortgage interest used to be uncapped, and then it was capped at $1 million, and then it was capped at 750,000. So if you, what I mean by that is that if you have a, I don't know, mortgages worth of a balance of 1.2 million, so the amounts over 750,000 of balance are not deductible. So let's say you have $1.2 million mortgage balance, you pay $50,000 worth of interest throughout the year. You're not going to be able to deduct $50,000 worth of interest on your taxes because of this clause right here. You have to apportion the interest that was paid, however much was under that $750,000 limit and however much was above gets excluded. And yeah, a whole lot of effective changes. This is going to apply in 2026. And yeah, so that rule stays basically. All right. Section 70109, extension and modification of limitation on casualty loss deduction. This one I really disagree with. So let's get into this a little bit. So we have all the date change stuff that we've seen. So removing the temporariness of Tax Cuts and Jobs Act and now making them permanent. And state declared disaster. Basically, if you have casualty losses, and casualty losses means, it used to mean theft or destruction. Now it basically just means some kind of loss in a declared disaster. And they are adding a new paragraph to include state declared disaster. So under the Tax Cuts and Jobs Act regime, it had to be a federally declared disaster, but now they're also including state declared disasters. I don't know how much difference there is between federally declared disasters and state declared disasters. I can't remember an incident of a state declaring a disaster and the federal not for that particular area, but maybe that's happened. It just hasn't come up in the ones that I've seen. But yeah, hurricanes, tornado, storm, high water, wind-driven water, tidal wave, tsunami, earthquake, volcanic eruption, landslide, mudslide, snowstorm, or drought, or regardless of any cause, any fire, flood, or explosion in any part of the state which the determination of the governor of such state or the mayor in the case of the District of Columbia and the secretary causes damage of sufficient severity and magnitude to warrant the application of rules in this section. So basically, if you have losses related to a disaster that is now either, as of 2026, now either federally declared or state declared, then you can deduct those losses in your itemized deductions to the extent that you're able to itemize anyways. How did that used to be? So under the old system before 2017, if a pipe broke in your house and you had losses that your insurance didn't cover, then that was a viable deduction that you could potentially take. If you had a bunch of stuff stolen, because it used to say theft and casualty, those were potential deductions that you could take on your taxes. But under the new system, it's only if you have losses and you're in one of these disaster areas. So like when the hurricanes blow through, a lot of times the whole state will be declared a disaster area, or sometimes multiple states. Sometimes it's county by county. And we'll have to see how the states, if they have any differentiation between federal and state declared disasters in 2026 and going forward. But by and large, you now have to have one of those external events rather than an internal event to your own property. So I personally am not a fan of that particular restriction. I think if you have a loss of some kind of property, then it's a loss, and you should be able to reconcile that on your taxes. But they didn't listen to me, so here we are with disaster-related casualty losses as opposed to general casualty losses. If this has affected you, then you've probably been familiar with the fact that this is externally related and not just theft or general casualty.